your net worth versus your estate worth. These are two very different things. Now, your net worth is easy to calculate. It is your assets minus your liabilities, and that will give you your net worth. Your estate worth factors in the taxes that are going to be owed on these assets when you pass away and when you go to give them down to the next generation. Now, the next generation being your children, your grandchildren, etc. So your estate worth is going to be less than your net worth, and oftentimes significantly less depending on the assets that you own. So it is important to know which of the assets you own have this hidden tax bill within them, how much is the tax bill going to be, and how are you going to pay for this tax bill in the most cost-effective manner. Now, I'm not talking about when one spouse passes away and there's a surviving spouse. That, of course, can be a tax-free rollover from spouse to spouse. I'm talking about when there is no second spouse or when both spouses pass away and the assets go down to the kids. That's when this tax bill occurs. So in that scenario, when you pass away and there's no surviving spouse or both spouses pass away, it's as if you've cashed out everything. And when you cash out everything, that's when the tax bill happens. So step one, it's looking at what assets are taxable or can be taxable when you pass away. And the list is long. It's everything from your RSPs to your RIFs to your non-registered stock portfolio. You might have secondary properties like rental properties. You might have a family cottage. If you bought your family cottage 20 years ago and it's worth a lot more today than it was 20 years ago, chances are there's going to be a tax bill owed on that growth. That's capital gains taxes. If you have a corporation or holdcos and you have assets within those, you have corporate investments, you have corporate real estate, maybe you have retained earnings and just cash sitting in these corporations. Well, if you pass away and that corporation needs to be closed down, that cash has to come out of the corporation and there's going to be a tax bill associated with that. So the list is very long, and by no means was that every asset that's taxable, but I just wanted to give you a bit of an idea of what could be taxable. The next step is determining how much is this tax bill going to be. And yes, that can be calculated. It can be complex. We have to go through the numbers, but that can be done. The third step, and pretty much the most important step in all of this, is figuring out a way to pay for this tax bill in the most cost-effective manner. So there are some terrible ways that you can try and pay for the taxes owed in your estate, and there are some extremely cost-effective ways of doing so. So the taxes owed in your estate are triggered when you pass away. So really, you only need this money the moment you pass away. You don't need this money before. Some of the worst ways to fund your tax bill owed in your estate could be things like using your RSPs or your RIFs. Those are fully taxable registered accounts. They're going to already lose upwards of 50% just on the value itself. So there's going to be not much left after that. Those are very, very poor ways of funding a tax bill in your estate. You might sell a property, or you have secondary properties, et cetera, to sell. It's an option, depending on timing of the market. I don't know if you want to put your family through a scenario where they're now forced to sell some properties just to get the liquidity they need for the estate, but it is an option. You could use cash, and cash is an option as well. There's no tax on cash when someone passes away, but I would still argue that using cash to pay a tax bill owed in the estate is still a very expensive way of doing so. I would say that one of the most cost-effective ways of paying for the taxes owed in your estate is going to be through the use of a life insurance policy. Now, say you had a tax bill of $1 million, and that's what you were going to owe when you passed away. And let's take the cash example. If you had $1 million in cash, yes, you could take that $1 million to pay off the $1 million owed in your estate. And it is problem solved. That's technically true. But I would say that using that $1 million to pay $1 million is a very poor way of using your own money. What I would suggest is taking a fraction of that $1 million, putting it towards a life insurance policy that will pay out $1 million to your beneficiary or estate, and they can take that $1 million to pay for the estate taxes. So if you had $1 million and the premiums on, let's say a tax-exempt whole life insurance policy were 30% of the cost of that $1 million to get $1 million policy, well, you've put up $300,000, you've saved $700,000. Now you can spend that $700 during your lifetime, and you end up with the same end result. So I'm not going to get too technical in this video, but the point of it is be aware of your taxes, be aware of what the amount of the taxes are, and most importantly, have a solution to pay for these taxes in the most cost-effective manner. Many families are able to self-insure and they have the means to pay for these taxes. So they say they don't need life insurance, they don't want to look at it. Even if you are capable of self-insuring and you have the means to pay for these estate taxes, it's still a very ineffective use of your money. So if you had that $1 million tax bill and you had $1 million in cash, yes, you can afford it, but why would you take $1 million to pay off $1 million? Why wouldn't you take a fraction of the $1 million to pay off the $1 million and keep the difference for your lifetime? Go spend it, go have fun with it, etc. So to summarize, there are 3 things you need to be aware of. Which assets do you own that have a tax bill in them? What is the tax bill? And how are you going to pay for this tax bill in the most cost-effective manner? Thanks for watching.